Hi, everybody. It's Tuesday afternoon after the close. I just want to make sure everybody can hear me okay. And they can see my screen here. You see four charts and some quotes on the left side. All right, awesome. Anyways, I hope most of you were able to listen to my GoView webinar, whatever you want to call it, from last night. Just want to give you some heads up, or a few heads up for today, and see how things pan out today rather than getting aggressive one way or the other. You know that we're still pretty kind of soft on this market. Dr. K, in a nutshell, how would you describe our view of the market currently?
Well, the model's on a sell signal. It's going to stay on a sell signal. No reason why it should switch. Of course, QE is still present, and we can see evidence of QE where the market wants to sell off, but then QE comes in, and there is some measure of support. So it keeps these sell-offs, I think, fairly restricted. And the sell-off we're seeing here is on very low volume as well. So I think we're going to continue to see, let's just say I wouldn't be surprised to see trendless action in this market. Which has been essentially the nature of this market since since January of this year.
Yeah, it's been pretty choppy. I mean, today what you're looking at here is the market did try to rally. Now we gapped down below the 50-day moving average on the Nasdaq yesterday, and I noted that yesterday we had undercut the Tuesday low of last week. So with logical, you might try to rally. I thought it was pretty weak though today, that the market wasn't really able to muster any kind of a rally, and you actually saw a pickup in volume. I'm going to confirm that looking at a couple of sources here. Dr. K, we did definitely have higher volume on the Nasdaq, right?
Yes, on the Nasdaq, but not on the S&P.
No, but the Nasdaq was down, and so now we're looking at how many distribution days?
Well, it's on a sell, so I essentially
Doesn't matter.
Yeah, that doesn't matter. I mean, the distribution days are continuing to pile up. And so things aren't looking real good here, and so it's good to be on the inverse ETF side of things.
Yeah, and that's pretty much where the model has stayed. Now, it was interesting. We get some people emailing us when you get this two-day bounce and telling us we should take the model to a neutral signal. But you got to remember, the model is based on objective rules for the most part. There's not that much discretion in the model other than perhaps the action of leading stocks, and there's nothing in leading stocks over the last several days to tell you that you're necessarily out of the woods or that we should arbitrarily, because a few people email us, that we should arbitrarily change the signal to a neutral signal. The signal is a signal, and until it changes, that's what it's going to remain on. So it's a sell so far, and despite the fact that it's been choppy since the sell signal came out on May 5th, we've still seen the market move lower. So if you took any kind of inverse ETF position, you're probably not hugely profitable, but I'm sure depending on what kind of leverage you're using, it's been somewhat profitable now, and you're seeing it start to pan out. The signals don't always pan out instantly. The market direction model is not a day trading tool. It is not a short-term trading tool. Oftentimes it can give several wrong signals before giving you the right signal. And the key is when the right signal shows up, you want to be in position and not questioning the model or trying to finesse it by thinking you need to go to neutral just because you have a couple of days of a rally or even a third day of a rally like you were trying to have in the middle of last week with the Nasdaq when it came up here. And this pretty much stalled out after 3 days up, and it's rolled over pretty good. Now we're seeing volume pick up. Now, yesterday I thought that you didn't have real heavy volume on the selling, and so that didn't really pan out into any further selling this morning on the opening. But by the end of the day, what do we see? You see volume picking up now, and we're rolling over lower. My guess is you're probably going to make a break soon for these lows here. You can see there's a couple of lows in here, and maybe try and undercut those, head down that way. That's what it looks like to me right now, if this were any normal type of market outside of the QE market. So the one thing about the QE is that it throws in these random rallies every once in a while that seem to come out of nowhere, and usually when everything looks very terrible. And so basically, it just kind of throws a monkey wrench into things when you think you're going one way or the other. So I think that in general, you just want to stay with the signal for now. I mentioned some stocks last night, and the reason I discussed those stocks last night is because I was on Fox Business News in the afternoon. They don't want to hear about shorting, and they don't want to hear about bear markets. So whenever I go on, I have to discuss things that might be positive if the market were able to find its feet if the market were able to turn around and go back to new highs and act more bullishly, but it's not, okay? But I did want to cover those names because I didn't want any of you, given the fact that you have access to Virtue of Selfish Investing and the webinar program that we have, I think you should have a little bit of inside knowledge in terms of why I was talking about those names. What do I see that's positive, and whether, in fact, they're really viable. I mean, they might be if the market righted itself and we saw follow-through, but the bottom line is you are in a downtrend. You're down over 4% now on the NASDAQ. Volume is up today, and you are basically not looking at any rally days yet. So there's no rally attempt now after making a fresh low here today. So now, at best, you're 4 days out or more from getting a buy signal, which the only way that could happen, Dr. K, would be a follow-through day. Is that correct?
Well, generally speaking, that would be correct. That's what we want to look for. However, there are some sub-rules where if the in other words, if the NASDAQ has not corrected by at least 6%, you don't need that follow-through day. So in other words, since it hasn't corrected by more than 6%, if the market was to say start rallying here, and there were no follow-through day, but we saw strengthening leader action, that could precipitate a buy signal, or at least a cash signal.
Gotcha. So for now, there's things that could happen. All we know for sure is right now we're on a sell signal. S&P over here in this little downtrend channel right now at the lows. Volume was lighter today. Maybe my guess you're going to see this break. It tried to rally to the 50-day moving average earlier today right here where I've got the cursor and didn't quite make it. So it looks like you may end up heading for this low. That's a possibility on the downside. The other factor is always QE2 and where they go with the budget deficit in terms of the solution. If it's defaulted to value, then we may see the dollar start to roll over again. And in fact, if you're watching the dollar today, we did actually have, let me move this chart out of the way here. We had a little pullback in the dollar, but it's actually in an uptrend off of its lows, and this is what's been causing some problems for the market, because you can see very clearly if you compare the dollar chart with, say, the NASDAQ chart, you can see that the bottom in the dollar occurred right here, which is right when the top in the market occurred over here. And so you can see that if the dollar were to roll over again, that might be a factor that causes stocks and commodities to turn back up to the upside rather. In the meantime, we're looking at gold, which I told you yesterday and also on Friday. Over the weekend, we had a pocket pivot on Friday, so it's continued to move higher on the futures, and the futures are actually trading pretty decent volume as far as gold goes. So that buy signal is still in effect. Dr. K, what would stop you out of this position right now?
In gold, well, essentially, I'm looking for gold to, at the very latest point, the 50-day moving average, since it tends to respect the 50 days. So that would be the point of no return, where it just starts to go through there on volume. At least a violation would certainly take me completely out of position.
Right. And right now we should mention, I think that's the only thing we're long. Do you have any TZA, Dr. K?
Yeah, I'm sitting on my TZA.
Yeah.
I also have AGQ. I'm sitting on some AGQ simply because
getting dragged up with gold.
It's getting dragged up with gold, and as long as it wants to continue to get dragged up, it can drag itself up in the most sloppy manner. But as long as gold remains constructive, I'm going to sit with my position and pyramid as well. Because if you go back to some other periods, I think maybe it was April 2006, where silver topped, and then it collapsed by about 20% in I think about 2 days. But gold had not topped yet, and then gold topped about 3 weeks later, dragging silver up with it. And interestingly, since silver is so volatile, silver actually outperformed gold between those 3 weeks. So you could have actually gone in and bought silver after the silver collapse and made pretty good money on the position.
Actually, I think we have to look at it there. That was April 2006 you're talking about?
I think it was April 2006, if memory serves. It's very clear on the chart that silver completely collapsed after having a bit of a climax. There we go.
Yeah, that was a climax top, and then you collapsed. You made another run for the highs.
Right,
then
and
you
you'll see that on a percentage basis. That's a huge move on silver,
right.
where and gold had not finished its move, and then Climax topped in May.
Okay, so if we reference this here, here's April 2006 here. This might be confusing because I got another chart showing the dates here, but let's move it down like that. I noticed there's a couple of you saying that you can't see video or you're not getting sound. That's probably a function of what's going on your end. We can't control it on our end, but rest assured that if you do miss any part of this, we are recording it, and we will have a recording that should be pretty flawless. They have been in the past, and we would expect that this one will be as well. So you will be able to see it recorded if there's anything that you do miss. I mean, there's not. I noticed GoToWebinar as well as GoView.com. They're not exactly perfect all the time. There are always bandwidth issues, I think, as well as operating system issues. And also, if people are running several different programs on their PCs, and their PCs aren't really equipped to run 500 programs the way ours are, then you may have a problem there. So, but just I would point out that we do video, not video, but record the video and the audio of these, and so it'll be available later. So you could get a move, I guess, back in silver to the upside like that from here. That's a possibility, and it wouldn't surprise me if there's no real resolution of the budget deficit and the issues there, and you end up just having more money printing or defaulting, devaluing, all of that stuff going on. In any case, if we go back to gold in 2006, remember we had that peak in silver in April of 2006. Takes me a little bit of time to get back there. Here we go. Yeah, now notice, remember that silver actually did a double, peaked out with gold and then actually went to a new high. And then as gold is doing this, silver actually was rallying a little bit better during this period, if you remember the chart that we just looked at. So that's the deal there. We're playing with the DGP, which is working okay right now. So you may be at the upper end of this rally, and you may just be in a base building period for now as far as gold and silver go. But the thing here is we'll accumulate a position, a 10% position here in the DGP, which is 2 times, so it's really effectively a 20% position. But what we'll be doing is working the position. If we get stopped out of a 10% position and lose 5% or something like that, 10%, that's only going to cost us 0.5 to 1%. So we're not really concerned with that. What we want to be able to do is try and accumulate gold on the pullback in a measured way using proper risk management, which means taking an initial position in here, which we did, and then watching the 50-day moving average and using that as our guide to sell the thing if it starts to break down again. But for now, we would assume that it'll try and hold at 50 days so we can work that position. If this builds consolidation and presents other buy points, we may pyramid the position. But it's going to depend on a lot of factors. And I think a lot of this stuff is just the wind blowing back and forth, and you see that a little bit in the market. But the market is breaking down. So the key here will be what happens with the dollar, I think. Yes, okay, what?
I'm going to say, in May of 2010, when QE1 ended, gold rallied fairly substantially for about a couple weeks when the market was collapsing. So when QE2 ends in June, I suppose there is a possibility of a replay of that, although usually the markets don't make things that obvious or that easy.
Yeah, you're right. In fact, yeah, when we got into the flash crash, which I think was May 6th or May 5th of last year, gold went onto an upside tear. So it's possible if we got some sort of a breakdown here, similar to what we had in the market, if we go to the NASDAQ here, okay, so let's look at this and kind of compare, at least try to compare apples to apples. What is this guy doing now? Here we go. This is 2010, and here's the breakdown. So here you have your break in April, okay, which occurs right at the end of April, and at the same time here on gold, you can see here, right at the end of April, we can actually line these up together, and if you watch the cursor here, and you also see the cursor over here, you see how the two of them work together on two different charts. So you can see how I'm going to track this as this progresses. So as we moved up here, the market tops here. Okay, gold has had a little pullback. Now the market blows to the downside, but gold continues to go higher. And you can see the red lines on my cursor, I guess you call them my bullseyes there, whatever, are showing you the difference there. So that could be a factor here with gold. if the market breaks down, we might see something similar in that gold kind of beelines to the upside while the market breaks down, much as it did last year in early May, late April, early May of 2010. Okay, so that's a good point that Dr. K makes, and it's a good reason why we want to own some gold here, outside of mostly holding cash. So right now, really, we're about 20% long gold and 80% in cash in the portfolio I run with Dr. K. Now myself, some of you who listened to the GoVideo.com from last night, I was talking about CRM. I had a little position in that. I sold it mainly because I wasn't liking the fact that I wasn't able to bust to new highs here. It reminds me a little bit of VMware, when VMware gapped up here, had an inside day here, and then the next day tried to rally higher and break out, and then it failed from there. So what I'm seeing here is CRM looks similar. Now I can always come back into this if I really want to, but the bottom line is we're in a sell signal on the model, and our experience when the model's on a sell signal, your odds of making money on the upside with long positions is not as great. So as we've been talking about, we want to maintain vigilance in terms of waiting for a window of opportunity to develop, okay? And if this is a breakout, there's still plenty of time to buy it. My guess is you might do a little more backing and filling. Morgan Stanley came out with a buy on CRM today. They obviously were watching me on Fox last week on Thursday, right? And they put a $200 price target, which sounds real nice, but we'll see if it actually ever gets there. But it's interesting they're doing it here on this breakout, which gets the stock going today in what was otherwise a weak tape. But you know, I think CRM is Salesforce, an interesting name and one to keep an eye on if it continues to act well here. I basically traded off the lows here up to here, just messing around, and not, for me, not a heavy position at all. And I'm just trying to get a feel for the market. But if I'm talking about something, we'll always let you know if we actually own it, just as a matter of disclosure. Fair disclosure. So, you know, that's what I'm looking at there. Molycorp, we're thinking could be a low. You're getting on balance more upside volume. You can look at over the last 6 days. You see the blue volume spikes, but you notice they're diminishing. And you may be forming a low here, but it may take some time for this to round out and build a base. So, again, I'm trying to trade this off the lows. It got up to the 65-day exponential today. Last week, it got up to the 50-day on a bounce. And my feeling here is it probably needs more time to build a base, so I'm not really going to mess with it. Now, someone brought something up that I think provides an opportunity to discuss what I think is a good lesson here. You know, we're talking about Molycorp here as potentially building a base here. Now, it's about 25, 26% off its peak. And we know that leading stocks will correct as much as 1.5 to 2.5 times the averages, and on a percentage basis as much as 30, 35%. Sometimes leading stocks will correct 50% and form these big, deep cup with handle formations. And what we're looking at on Molycorp is this. You have, and this is what I talked about last night on the GoView.com video. You started here at 14 bucks a share when the thing came public. You had one run-up, big run-up. Okay, then you build a base. You break out, build another base, you break out. So how many bases is that? You've got 2 bases now. So you're not really in any late stage yet. This could be a new base, but if the market went through a correction and this builds a new base, you could be starting over with a first stage base. We also don't get into the whole concept of counting bases 1, 2, 3, and you're out. That's often not the case. A lot of leading stocks can form 5, 6, 7, 8 bases on the way up in some exceptional circumstances, or cases rather. And that is often what happens with leading stocks. And you go look at some of your biggest leaders; they're not 3 and out. So we don't really buy into that whole concept. I know a lot of people fixate on it, but late stage bases are something that you usually find out about after the fact, not before they happen. Simply by saying, "Oh, this is a third stage base; it's going to fail." That's not always the case. But what we like here is if you look at this on a weekly basis, you come down 2 weeks hard with the market off the peak. Now remember, it's had a big run, 14 to 79. That's a big run, okay? And so now, given that big run, the fundamentals, however, are still intact in terms of the forward estimates, and as far as we're concerned, the theme for rare earth metals remains intact. Dr. K, are you in agreement there?
Absolutely. And Molycorp is the leader in this space. So, and also with the moves out of China, I think that further favors the space. So I'm just waiting for Molycorp to finish base building and to issue the next pocket pivot.
Yeah, and I would note, I like to get in here along the lows and trade a small position because it's giving me a feel, and you can definitely feel some support for the stock in here. $9.44 are the estimates for 2013, so that's all still intact. And the whole situation with rare earths, I don't think is going to diminish. Even if China slows down, there's always talk of them being a big component in demand, but I think what the situation in China has really brought and made plain to the rest of the world is that the rest of the world hasn't developed rare earth resources to the extent that they should. And so I think the movement towards rare earth, developing rare earth resources, is going to continue over the longer term. And so we want to watch these stocks like MCP. We don't, RE is another one, but not as high quality by any measure as far as we're concerned. Molycorp is the big stock in rare earths. Okay, that's the play, and you can look at the sponsorship there. It's got some pretty big sponsorship. So that's how we define big stocks. They have institutional sponsorship. They trade a lot of volume, not just because they trade a lot of volume, but because that is a sign of institutions trafficking in the stock on a regular basis. And that is the essence of a big stock, a leading stock that institutions are following widely and that own big positions in. It's not something that you can really measure. I know people ask whether this metric or that metric determines a big stock, but a big stock is often something that's pretty easy to see. You look at the leading stocks in any bull phase, and you can see which ones are trading the biggest volume, which ones have the best sponsorship, which ones are owned by some of the best institutional investors, the best mutual funds, the best hedge funds, okay? Those are big stocks, and those are things that are somewhat more qualitative than they are quantitative. So, everybody likes to have the black box answer to everything in the market, but the market is full of many shades of gray, and learning to develop your judgment with respect to understanding how the different shades of gray work in different market environments and under which circumstances when it comes to leadership is the whole process of developing experience and developing judgment. Okay, so that's one thing I want to make clear, but I would say here that this is a leading stock, and you're correct, and you're coming down 3 weeks. Notice how the weekly range here compresses a bit. You close mid-range. The selling diminishes here, so you're trying to find some support, and you're right on top of this 55 area. Okay, that actually looks pretty well contained. Now, somebody asked a good question, and they asked, would you apply then that same thinking to this stock, Stratasys? And I would say no, they're not really the same situation. For one thing, Stratasys is a stock that's been around forever. Look, I'm going to go back with the weekly chart, and it's just been, back and forth all its life, and then finally has this little move, which really isn't that much of a move, going from like 25 to it doubles, but not a big 400% move like you see in Molycorp. Okay, and I don't think thematically it's that compelling. It's also not a huge, widely owned stock, and not as much of a big stock, in my view, as, say, Molycorp is, both on a thematic basis and in terms of sponsorship. But that's not really the defining factor here. This is not the same thing as Molycorp by a long shot, for the simple reason that look at the way it's just breaking down. The volume picks up again. You go 1 week down, 2 weeks down, it tries to rally, just fails again, and comes down again hard. Finds no support on top of the prior base, and it's gone through the 200-day moving average. Okay, so what you're looking at here is just a crummy stock, and I'd say Molycorp is way above its 200-day moving average. It's holding support here. Notice that the percent declines are not nearly as great as they are in a stock like Stratasys. So, when stocks are pulling back, and if you think a stock is a leading stock, yeah, you can watch it and see if it does form a base. I don't know, maybe Stratasys does come around and build a base, but it would be a pretty deep base with a very steep left side. I think I like the way Molycorp is, it's going to freak out on me again. Here we go. I like the way it's kind of rounding out a little bit here. So, that looks a little better. And plus has that theme going for it, okay. So I trade a little bit of it, but it's getting resistance at the 65-day exponential on the daily chart. Today, so maybe back and fill. Dr. K, you're just watching this thing, right? You're not messing with it at all.
Yeah, there's no point in doing much of anything right now.
Yeah. And just so you know, Dr. K and I don't rehearse any of this ahead of time. We've talked a little bit via IM throughout the day, but mostly we just insult each other on a day where we're not doing too much, so not too much else to do other than get into a little bit of razzing each other over whatever we can find to razz each other over. But in any case, getting back to business here. Okay, dollar trying to rally.
I would also make a point, though, that when the market does get interesting, in other words, if there's a lot of stocks that are worth buying, stuff like this, stuff like Molycorp that's in the middle of the base building period should not take your attention away from the stocks at hand that actually might be ready to break out. So, I mean, obviously, time is of the essence, and it's very critical that you don't let. It's critical you keep your focus on the stocks that have the best potential at that given time, and certainly the 90s were a great study in that, and so was any period in this last 10 years where the window was very wide open, such as late 2006.
So that's all to say that you're probably better off, if you're looking at buying anything, looking at a breakout, maybe like this. Green Mountain came out. We had a pocket pivot yesterday. It was added to the NASDAQ 100, but you could sort of see this one setting up on the weekly chart because it's pretty tight in here. It was up last week. I would prefer to see it, drifting down for these 2 weeks in here, but it's pretty tight in here, and I think there are a lot of skeptics. Interestingly, when I was at the Fox Business News, or Fox Studios, rather, in West LA yesterday, which now I'm almost a regular there, they have a big old Green Mountain coffee Keurig coffee thing, so I had a little bit before I went on, just so I'd be hyped up enough to deal with Liz Clayman, because she's quite a ball of energy, as I'm sure you can all tell. But in any case, Green Mountain acts pretty well. It was kind of interesting. Well, I shouldn't say kind of interesting. It's actually very interesting to see Netflix pop a pocket pivot yesterday, but it breaks out to new highs. And, of course, the weight of the market keeps it from moving higher. But it's interesting that it's holding up here. It's very stubborn. So, not letting go. Last night I looked at Apple, too, and Apple's just going sideways. Hey, Dr. K, do you have any general view on Apple?
Well, it's one of the most widely followed institutional stocks, and so it's a reflection of the general market. And, of course, it's under the critical moving averages, the 50 days, just like the general market is. So I would expect that, so go the general market, so go Apple, and perhaps vice versa as well, simply because if Apple were to start to have real problems, that would obviously affect the NASDAQ.
Right. I discussed that last night, that you could consider Apple to be something of a barometer as well, because if it starts to break down, there may be some problems. We also had Chipotle Mexican Grill. Had a little pocket pivot. These are kind of marginal. Now, they are pocket pivots, but, with the tide of the market against the long side, you're not going to see much progress. It's interesting, though, to see this because it shows you how stubborn some of these names are. And also maybe that a lot of shorts have been piling into these names thinking that they're breaking down. And notice how CMG loves to fake you out. Here, it looks like it's breaking out, and then it breaks down and looks like it's going to be a late-stage failed base, and it turns around and comes back up on virtually no volume. You get 1 day of volume here, but after that it's just a wedging rally with the volume declining. And then you just keep trucking higher without any real decisive volume. But notice nobody's really selling the stock outside of the big volume that you saw the day after earnings came out. So just interesting stuff. Nothing we really want to buy into, but interesting action. AutoZone, portfolio similar, sold out. Up in here this day. So he misses out on a little bit of action here, but that would have meant sitting through all this and playing earnings roulette. And I think American Advanced Auto Parts came out with earnings and it blew up. So on that basis, would you really want to sit with AutoZone? Probably not. Is this a viable gap up? Yes, technically. But again, you have the market kind of working against these situations. And AutoZone's a little bit on the thin side in terms of it tends to move around a lot and not much volume. Today, though, you had huge volume. Dr. K, what's your take on this as a viable gap up?
Well, I mean, again, in this market environment, if I'm going to buy a stock, I really want it to be a true leading stock, all ducks in a row. AutoZone in a normal market environment is a viable gap up. In this kind of market, I'm a little more hesitant. If I were to buy any of it, it would be a half position at most. Yeah.
So, anything on the long side is just take it slow. Like I tried out some CRM and MCP, and those worked for me. I took some short-term profits. But I don't really think that I'm looking at a trending situation in either one of those just yet. CRM is closer though because it's approaching new highs, and in fact, I believe today was an all-time closing high for the stock. So that's a good sign. And if you're going to go after any leadership, that's kind of what you want, I think. And Salesforce has the social media thing going forward as well in a much more realistic manner, I think, than LinkedIn. We've been debating LinkedIn all week long since they came public last week. So, this just speaks to the fact that you don't really want to buy these things on the first day. We wrote an article for townhall.com, and you got to be careful about getting sucked in to LinkedIn, okay? Because if you bought up here at 122, you definitely got sucked in. Now, if you got shares on the offering, you're a happy camper right now, and you probably, as long as it holds up, you watch the stock and see if it builds a base. But on a weekly chart, that's what you look like. So that's not the sort of pattern you're buying into. Now, just go back and think about stock like Google back when it came public. And I'm going to go back in time here. This will take me about 20 minutes to get back. And here we go. Remember when Google came public, the Dutch auction priced it at $85. And some people say that LinkedIn should have done the same thing because they actually underpriced it, and it was a ripoff for the company. But the investors who bought the stock in the IPO, I'm sure, are very happy. But you had some time here with Google. It ran up, and I remember buying this as it broke out of this little formation, little flag formation, or we used to call it the IPO U-turn pattern. When I was at O'Neill, that was actually made up by one of the institutional salesmen at O'Neill, Mike Lowry. Although I think Dr. K claims that he also came up with that. Is that true, Dr. K?
I call it the U-turn, actually, very early on before U-turn was coined, which actually is that's a better name than what I came up with. I just called it the U pattern. And that seemed to stick in data research and some of these other departments. And Jonathan Liebert would come by and say, hey, did you see any more U patterns lately?
Yeah, eBay also made a U-turn back in 1998. But that's what you want to wait for. Wait for the stock to set up in a base. So anybody asking us about that, that's what you do right now. Don't even think about it until you see it on a weekly chart looking okay. I'm looking at I'm going to go through some names here. So just to summarize where we're at the market, you're on a sell signal. Going long is probably a low probability proposition. Holding on to your inverse ETF positions looks to be working. And there are places probably where you can pyramid as the market weakens. I would say once you've broken some key support and you break down and then rally back up, that may be places to add. How would you handle? Let's use an example, Dr. Say you're long the SQQQ, so you're basically short the Nasdaq here. Okay, where are we? Where are we going? Here we go. So let's say right now you took initial position on the sell signal, which was this day, and you sat with it now. And would you be adding to your position here?
Well, see, I don't like to pyramid on the basis of general ETFs. In other words, okay. SQQQ is an inverse of the Nasdaq 100 or the SPY. Right. Any of the general ETFs are mirroring market averages, and I find that pyramiding market averages is based on what I've tried in the past. It doesn't work so well. I find what works best is you have a set amount of capital allocated for the model, and on a buy signal you buy your chosen ETF. On a sell signal you buy your chosen inverse ETF. And I mean, some of our members actually do that with the Qs. Some of our more aggressive members use the TNA or the TYH. Although I've expressed in prior reports that the TNA has a better risk-reward profile than the TYH. So
are you saying? Are you saying then that when you get the sell signal, you just take the position in the inverse ETF in full, and that's the max that you're going to deal with for the whole duration of the sell signal?
That's right. And so, in other words, you allocate a certain percentage of your capital each time, and you keep that percentage the same, and then you can reproduce the tables that we have shown on the website. In other words, you don't try to get cute by trying to position size, thinking, well, this signal's weaker than the other, so I'm only going to buy 10%, and this one's really strong, so I'm going to buy 100%. Because in my experience, that gets you in trouble. In other words, we get a lot of messages saying, well, how strong is this signal? I'd like to. I mean, my feeling is that it's a strong signal, but the model and the market really don't care what my feelings are, and I've found that there's no real way to get ahead of the model in terms of performance by trying to judge the strength of a signal.
Good answer. Okay. I'm just looking through here some of the questions we have. People are just asking about random stocks. And unless we have a stock that we're following, if somebody's asking about this and what we think about it, well, what do you want us to tell you? It's a gap up today. The volume is, well, that's not the right pattern. Hold on. Let me get the right chart out. That's a viable gap up. I don't know if the numbers or something. All I know is this doesn't show up on my radar screen because it doesn't.
Well, the earnings are negative the last 2 quarters.
Yeah, so we won't even mess with that kind of thing. So, so when people ask us, what do you think of this? What do you think of that? Well, if the stock's moving up, there's nothing to think. It's going up, but would we buy it? Probably not, because it doesn't really hit our radar screen as far as the earnings go. If Arco offered a pocket pivot, would we buy it? I don't know. If my aunt grew a certain part of her anatomy, would she become my uncle? I don't know. This is too hypothetical. I don't know if I would buy it. Why would I buy the stock? Somebody tell me why I would buy the stock. Earnings are, it's a retail restaurant.
Last quarter, they accelerated on both counts.
You would have to show a pocket
exciting. It's not that exciting a stock, but yeah, in when the model's on a sell signal, I would also be very careful about IPOs because they tend to be a lot more volatile. So maybe in a better market environment, I would watch for a pocket pivot on this kind of stock, but not in this market. If this were a real hot IPO and it had a better pattern than this and it had a pocket pivot, sure, I may take a position in it, but not this kind of stock.
Not today, and it looks like it tried to today. Would that be a pocket pivot? Yeah, but it kind of reversed. But it's kind of not the highest quality stock. It looks pretty nice on the weekly chart, though, I might add. Let's see if I can find my weekly in here. This really doesn't show it off as well, but if you looked at it on some other systems, it looks pretty tight in here. So I don't know. Maybe you could buy it if you had a bona fide pocket pivot, but not really the highest quality name in our view. But it doesn't mean you can't try it if it gives you a buy signal. Let's see, SKF. Somebody's asking about SKF. That's inverse. Is this a 2 times inverse financials? It's basically doing the opposite of the XLF. The XLF has been coming down because Goldman's getting pounded. Because you're going to get, supposedly, the government's after them for all sorts of fun things. But also, you look at some of the other, JP Morgan has been coming off, Wells Fargo has been coming off, Bank of America.
Goldman Sachs, that was the bellwether, and that one's not getting hit.
Yeah, and so, the SKF, what you're asking us is, like, should I go short the financials in general? I don't know. Should you short the financials? They're all down now, so don't really need to mess with it. If you're trying to play this market on the downside based on the sell signal, just use one of the index ETFs. Getting too specific with financials, they're squirrely, and they're also subject to various news moves. Depending on what's going on with QE and what's going on with the way the government's handling any culpability any of the financial institutions have with respect to the mortgage crisis. So, kind of a shot in the dark. So we would prefer to just go with the inverse ETFs. So somebody's asking, did Dr. K coin plutonium? Dr. K coin plutonium as in what? Make plutonium coins, or are you asking?
Actually, it was Glenn, my thesis advisor, Glenn Seaborg. He invented plutonium. He's the man. He's the guy who started it off. And boy, I don't even remember what year it was, but that was the first of a run of elements that he was able to make. Plutonium and 9 other elements.
Okay, I think we talked about silver and gold and what's going on with that. We did elaborate on that. Now somebody says, when you say nibbling on the stock, what do you mean? What is it? 5%, 10%? What's concentrated? What is a concentrated position in one person is not to another person. And to me, 10% is like buying nothing. Okay, so if I was going to play 10%, I might as well buy nothing, in my view, at least for my own personal account. When we're dealing with ETFs and we want to take a 10% in the DGP with the idea that we might pyramid gold over the longer term, that's a different story. But when I say I'm nibbling, it can be 20, 30% position. Because if I'm really going in, charging in, and I like something a lot, I'll go over 50 pretty quickly. In some cases 100. But I'm just very aggressive when I think I see something moving and I see the line of least resistance opening up for me. But the key is, and I've learned over time, that when you're that aggressive that quickly, and if I consider 30% position to be nibbling, and some of you would think that's crazy to start out that way anyways, but that's just kind of the way I move. I've been a plunger most of my life, and Bill O'Neill said I was traded a lot like him in the sense that I was a plunger, but I've had to learn over time to deal with the fact that if you are going to be a plunger, there's a time to plunge and there's a time to not plunge. So to me, 20, 30% positions are easy for me to handle, and to me that's nibbling. So, I think it was a 30% position I had in CRM, and I think about a 20% position in MCP, okay? And to me, that's nibbling. So to you, that may not be nibbling. That may be chomping away and taking big bites of a Big Mac or something like that. I don't know. But to me, that's nibbling because it's easily maneuverable. What was that, Dr. K?
Yeah, and everyone's got to find what suits their personality, and the worst thing is to get swayed by someone else's position sizing rules just because, let's say, they're really successful, and so you want to adopt their position sizing technique. That's a terrible way to go about it because it might not suit your trading personality. And in our next book, we're going to discuss that because it's really all about understanding yourself. In other words, there are traders that have tiny little positions, what Bill O'Neill would call tiny little positions, 10 or 20% of position, and they have astounding returns, just as good as the guys who plunge, who go 50, 100, 150% in. So in other words, I've never been able to say, okay, this type of position sizing will over time get you higher returns. There is no. The only thing I can really say is if you're going to go in too small, if your position sizes say are less than 10% at the maximum, then that's over diversification, and you probably will limit your upside as a result. But if you're at least if you're at 15%, 20% position sizes or higher, you have just as good a shot at making triple-digit returns as someone who goes in and plunges.
Good answer. So it basically depends on you. Not there is no definition of nibbling. It's a relative term. So here's a good question for you, Dr. K. Regarding the ETFs that you would use on a market direction model signal. Would trading more specific ETFs that mirror sectors and subsectors using the VOSI approach be considered a reasonable application of what you are teaching us?
Sure. The thing with the model is that on a buy signal, if you're going to buy an ETF that is specific, that you do a quick study to make sure that there is a high degree of correlation between that specific ETF and the general market. That's really the key. So in other words, on a precious metal ETF like silver or gold, they don't have to correlate with the market very much. So you should be very careful about buying silver or gold ETFs on the basis of the model signals. The same would go for ETFs that are concentrated in commodities, because sometimes we'll see stocks go higher while commodities languish. Anyway, that would be my answer.
Good answer. So the basic answer there is, buying a sector ETF on a market direction model signal. So in other words, thinking you're going to go after a particular sector if the model goes to a sell signal, it really depends on how well that ETF is going to correlate to any general market move. And so unless you really think you have a bead on a particular sector being particularly sensitive to a downtrend in the market at any given time, you're probably better off going with the general ETF. Correct, Dr. K?
That's right. This correlation is really the key, because the other thing is people ask me, well, what's the scalability of your timing model? Well, it's really billions and billions and billions of dollars, simply because there's a lot of ETFs that exist today that didn't 3 years ago, that correlate to a very high degree. So on a buy signal, you could buy a whole basket of these things. You could buy $10 billion worth of these ETFs, enough so that you're not moving the price or moving the market around. And it's a great thing because 3 years ago or longer, there were far fewer ETFs that existed. So naturally, that would affect the scalability.
Right. Let's see here. I wanted to go over the short side very quickly. There's a couple other. How much time do you spend watching the market each day? I spend 22.8 minutes each day exactly. No more, no less. I don't know. It depends how much fun you have watching the market. We like to run screens, and that's basically what we do all day. I just run screens all day. I'm looking at different things going on in terms of the sectors and which sectors are leading the market on any given day, which sectors are moving up in leadership, which stocks are up on volume, down on volume, where am I seeing the stocks pulling down into support or rallying into resistance or whatever, just monitoring all my lists. Staring at the quote screen flashing is probably not good for you, but we think running screens on a regular basis during the day, if you can, and you don't have a real job. Well, our job's real too, but it doesn't seem like it. But when I mean a real job, that's a job you hate, I guess, or a job you have to go to when you'd rather be home trading, right? So if you don't have one of those kind of jobs and you can sit and watch the market, I think you're better off screening the market and having a tool somewhere, somehow, that allows you to screen the market in real time and check watch lists in real time and see what's going on. Other than that, just like watching the market, to me, implies you're staring at your monitor all day, which I think is bad for your eyes, number one. It probably doesn't help you too much. There are some environments where I do like to watch things trade just to get a sense of how they move, but I've actually found it's better simply to take a small position in something, and that gives you a better feel than just staring at it, flashing at you on the monitor.
Also, if you as you build your watch list, it's a good idea to keep alert prices on the high and low side. That's what I do. That's just always been my style.
Right,
right. And if the market's strong, then I might have 100 stocks on that list or more. And if it's weak, then there might just be a scant few on there that I'm tracking. And that allows me to not have to watch the screen at all until I hear my system alert me. And it's nice because it keeps my mind fresh. If I'm sitting there watching the screens and watching all the little ticks and everything, it's also liable to push me out of the position, especially if the market has some sort of momentary negative reaction that inevitably would affect the general market and the stocks that I'm holding.
Yeah. I know that when on my chart it says O'Neill volume here, and everybody wants to know if that's some special secret thing. It actually doesn't mean anything. It's just that the friend of ours, Mike Scott, who's been real helpful in terms of setting up our EFS files and things like that for us. This is the blue and red type of O'Neill color scheme we use. If you go and look at things like daily graphs, they actually use a magenta color for the down days. I like to use a red, and I just call it, these are O'Neill type colors. In other words, the colors I used to use when I was at O'Neill, and so we just labeled it that. And it basically refers to the fact that it makes the bars red for down and blue for up. So there's nothing special there. I use a 2-day RSI. Sometimes it's helpful when you're shorting. You'll notice if you get a peak in here, something you could be shorting like LVS on these rallies. When it hits a peak like that, sometimes that's helpful in terms of knowing when you're a little bit stretched one way or the other if you're working a position on the short side, okay? And I think I want to just quickly go through some names just to give you a sense of what we're seeing in terms of what's going on overall with leadership. You have Baidu and the Chinese internets. I talked about these last night. They're acting badly. Could just be building bases, but not really any buy points yet, okay? If you're looking at some of the metal stocks with Cliff Natural Resources, this is kind of looking like a rolling top, kind of a dome of death, but not really a discernible shortable pattern, excuse me, just yet. Freeport Macro, and I was actually messing around with this earlier today because it had opened right at this resistance that I saw, which was the high of 3 days ago. So I actually shorted some of it. I think I made a few cents. It really wasn't giving way. And I'm just kind of filling this out because this kind of looks like you're sitting in some kind of a head and shoulders formation, but it's more of a rolling head and shoulders formation. It's not one of those big break off the peak formations that FNSR is, where you have this major break, and notice how this is coming down. FNSR is still in play. We put these out, FNSR and LVS, the other day as short sale setups, and they've moved lower since then. But I thought mostly we wanted to put those out there on weekly charts because it gives you a real good idea of what you should use as a template when you're looking for short sale setups. And the two are basically the late stage failed base, which LVS is, and then the big head and shoulders, which Finisar is. Now, Finisar comes out with earnings in early June. I don't know if that really takes the stock down. And some people were asking whether the fact that you don't have heavy downside volume off these peaks, whether that's a big problem. And I would say that it's not. And I want to show you one of the examples that I always look at when I think it's a great short sale type setup. If you ever see a stock setup like Crocs did in 2007, then that is a thing to go after. But you can see here, when you rolled over on this structure, there's no real volume here. There's some upside volume as you're coming up in here, picks up a little bit in here, but as it's rolling over, you're not seeing the volume pick up. And a lot of times what these things will do is just roll over the right side on not too much volume. Sometimes you will see the volume pick up, but I found that either way it doesn't make a heck of a lot of difference. It's kind of critical where the volume shows up when the thing starts to break down. And you notice the downside volume as it breaks support here at the 35 level on Crocs back in actually early 2008 after topping in 2007. You can see the volume picking up. So if we go back to Finisar today, not a lot of volume. That's not very meaningful. What I would say is you may see volume pick up when it undercuts this low, which is somewhere around 20, just under 21. So it's still, this thing's still looking pretty weak. But you got to figure it's down a good 15% off of the peak here. And a lot of times all we're trying to get is about 15%, maybe 20% and get away with it on the downside when we're shorting a stock. So to some extent, if you're short Finisar up in here, you may be close to a profit objective. So keep in mind that as it heads for this low right here, it could bounce and form another right shoulder. That's a possibility. Or it could just sit there, do nothing, hang around here for a little while, and then when earnings come out, it breaks wide open. So that's just something to keep in mind if you're playing that. Now LVS just continues to move lower, and I think LVS is a great example of how a stock can shift, and you kind of have to shift with it. Because remember, we saw this as a late stage failed base. We went shorted here, covered around here if you were following the short sale setups back then. And then stock came up, had a pocket pivot here, so it actually becomes a long situation here, but immediately reverts back to a late stage failed base. And you can see how you're shifting with this, okay? And that's why you have to be flexible a lot of times and also be willing to take profits when you get a nice break to the downside 15-20% that you can bank. So here you have this thing breaking down. It's just continuing to break down. My guess is you're eventually headed for this low. And then once you get to this low down here, just above 35, you may undercut and then try to rally. But it's looking pretty weak. Not a lot of decisive volume as it rolls over, but it is looking pretty weak. So those are really the only two perfect short sale setups that we saw last week, okay? F5, now something I've noticed, F5, here's your big head and shoulders, and it is starting to have some problems here. You had a rally up in the 200-day here on, I think it was CRM's earnings news, or maybe, what caused that? Was that another, Dr. K, was that another cloud networker coming out with earnings or something that caused that move?
I don't know. I didn't see any. Well, I didn't see any major cloud company getting hit. Let's see. Yeah, because I have a lot of the cloud stocks on my list, and I didn't see anything have a huge breakdown. I mean, they haven't been doing well, but there was nothing.
Right.
That was
but you notice, this is almost a shortable rally here. And to tell you the truth, probably should have hit that thing right there because you below average volume here. You did stall here on earnings when they came out with earnings, and then reversed, filled the gap, turned back up into the 200-day moving, and now you're breaking down again. Not heavy volume, but you are in this head and shoulders formation. And let's look at it on a weekly chart. So yeah, you could be heading down towards the neckline, which is down here below 90. That's how you're looking at. Or you may undercut this low here on the right shoulder here. But see, that's the pattern that you're really looking for. Now, the one thing I noticed, and it may be another reason why something like F5 is a short, is that today what I noticed is some weakness in what I would call the cloud networking stocks. In other words, cloud computing plays that are more related to networking, more of the hardware type end.
Yeah,
Things for the
Aaron actually had a bit of a dump in 3 days
Yeah,
ago.
and I
So
think that got the whole thing started. And that, so there was one that broke down. Acme Packet is breaking down. Riverbed, which I've been looking at, and this is another one. You know, I was testing a short in here, and it's actually started to work. It really wasn't feeling like it was ready to go one way or another. I would watch it right now. It's on top of the 50-day moving average. However, as a potential head and shoulders, one thing that Riverbed lacks, and I think you all by now should be able to recognize that, is it doesn't have the big break, the huge volume downside break on the right side of the head. If this is the head right here, there's no real big break like you have with whoops, come on, with F5, see the big volume break, or with FNSR, the big volume break, or even with Crocs, going back to, we'll probably get there a lot faster, going back to 2007. So that's the one thing. But what I notice is that you do see weakness on the cloud computing networking side of the equation here, whereas I think the softwares like Salesforce, CRM, Tibco, VMware, even Fortinet, which is security, and I think that relates to the cloud, seem to be acting okay here, and there's some divergence in that the networkers are all starting to roll over. So I think that could be a reason to go after F5 here, particularly if you see it blow down through the 50-day moving average, which is the blue line, the 10-week moving average, or 50-day, depending on how you're scaling it, weekly or daily. But that's maybe telling you that the whole group is coming off, and so you go after one of the weaker ones in the right setup, and you may have a shot at making some money on the downside. Okay. But that's really all I'm seeing on the short side. I see these patterns in, FCX. That looks like a head and shoulders. You're down around support. You might want to rally here. It might break down. I don't know, but it's kind of a rolling one. It doesn't have that big break that defines the right side of the head. Note that JDSU getting a little sloppy. That's true. Somebody just points that out. And that's another networker that's weak. Finisar is another network that's weak too. So I think there's a theme here where it's telling you that the group is breaking down. So if you go after some of the weaker ones, Finisar is weak, F5 is weak, and they have the right kind of breakdown, these may be the ones to go after on the basis that you're also seeing Riverbed, you're also seeing Acme Packet, you're also seeing Aruba Networks all break down. So there's a group theme here that reinforces the short sale targets, which for us right now in that area are F5 and Finisar. Okay, and that's kind of how we're looking at the short side right now. And remember, if the market's topping here and you're going into a real bear market, it'll take some time for the short side to pan out. We have to remember that if we go back to the breakdown, the market topped in October of 2007, right? And you had stocks like Mosaic continue to go higher, and then it takes some time for them to finally just bust wide open. Crocs actually broke down in late 2007. Did you have something to say, Dr. K?
No.
Okay.
All good.
And so, some of these, it's still early, so yeah, you can go after LVS and F5 and Finisar, and they're working so far slightly, but you're not really getting the meat of the breaks just yet where you're really going to score. And so it's still early, so there's plenty of time. No need to rush into it. If you got a couple, if you got some positions short on Finisar or F5, and you're making a little money, or LVS, I think that's great, and you're doing better than I am on the short side as far as those individual names go. But I don't really see right now as necessarily the high probability break. That could change in a matter of days, or one day even. And after today's action, we thought things were pretty weak. Okay. So you can expect that during the week we'll have more of these GoView webinars where I'll just Dr. Cameron and I will review the market at the end of the day if anything comes up during the week. I think that most of you find the recorded versions to be easier to access than the live ones. But nevertheless, we wanted to do live ones in any case so people can ask questions in real time. And if you do have anything you want us to cover in a recorded GoView webinar, please let us know. So I think for now we've covered everything we want to cover, at least for right now, and we'll see how things develop. So we want to thank everyone for showing up. I hope it's helpful in terms of giving you an idea of what gold might do if the market breaks down, as well as some of these short sale setups, and of course the scant few long situations that might be there. So you're welcome, everybody who's saying thanks. We appreciate that. And anything else to add, Dr. K, before we close it out?
No, I think let's just continue to ride this choppy market, and let's be patient for the next trend, because it will emerge, and it's just a question of when. So it's always good to keep vigilant and a watchful eye on the market, even when it's like it's been trading this year.
All right, very good. All right, everybody, we'll talk to you later. Take care and happy trading.
Yeah.
The Orgit